All right. Hello. This is fixed income analysis of chapters 1 through 5. Um, I'm gonna present chapters 1 and 2, and then Chris and Ryan will take over for the last three. Let's see if I can get this to work. There we go. So the first two chapters of the book are pretty basic. It really lays out the key features of bonds, and not just bonds, but fixed income securities as a whole. This is the first paragraph, one of the first paragraphs that they put in the book. Fixed income securities constitute the most prevalent means of raising capital globally based on total market value. These instruments allow governments, companies, and other issuers to borrow from investors, promising future interest payments and the return of principal, which are contractually obligations of the issuer. Um, so I highlighted kind of the two main parts of what you're getting as an investor, um, the return of your principal, and then the semi-annual, annual, monthly interest payments. Um, for private companies, fixed income securities are the largest source of capital, mainly due to the fact that they don't issue equity. Their only sourcing for capital is through debt. For public companies, investors' interest payments and repayment of principal have a higher priority claim on the company's earnings compared to the claim of a shareholder. So, um, in the case of bankruptcy or the company goes down, fixed income investors have a little bit higher of a stake than equity holders on the hierarchy. So if there's a chance that some money gets tossed around, they may get theirs first. All right. So kind of the main fixed income security talked about through these first two chapters is a bond. A bond is a contractual agreement between an issuer and an investor or bondholder. Um, the bond features determine the bond's cash flows, and therefore are key to determinants and of the investor's expected and actual return. Um, so what are the bond features? Pretty much everything you click on your calculator when you're doing time value money: maturity, par value, coupon rate, frequency, um, all pretty familiar terms, but we'll go through the definitions of each of them. So maturity simply is just the date when the bond matures, or when the issuer has to um, redeem the bond and pay the outstanding principal. Um, so every bond question says a bond that matures in, or 10-year bond or 5-year bond, that's, they're talking about the maturity. The tenure is just the time remaining until maturity. So just from today until when it matures. The par value, or principal, is the amount that the issuer agrees to repay the bondholder at maturity. The coupon rate is the interest rate that the issuer agrees to pay until maturity. Um, the annual amount of interest uh, payments made is called the coupon. So if it's a 10-year 6% bond, that 6% is the coupon rate. That's what they're referring to. So bond's coupon, so they usually give you the coupon rate. To find the actual coupon itself, you just multiply the rate that they give you by the par value of a bond. So if it's $100 bond and a 5% coupon, it's a $5, or 5% coupon rate, it's a $5 coupon. Um, so coupons in themselves can be paid in different time spans. They can be annually, semi-annually, quarterly, monthly. So in the example here at the bottom of the slide, if a bond with a 6% coupon, $100 par value, makes annual payments $6. If it was semi-annual, it'd be $3, every 6 months, $1.50 every 3 months for quarterly payments, and so on. So this goes a little more in depth about the payment structure of different coupons. So like I just said, a bond's coupon is determined by multiplying the coupon rate by the par value. Coupons can be paid in different periods. I just said all that. I don't know why I put that in twice. All right, let's get into different types of bonds. So kind of the main bond we work with a lot, or think of, what I think of in my head is a conventional bond, or a plain vanilla bond. It pays a fixed interest rate, and the coupon doesn't change over the bond's life. So it's kind of the simplest example, like the one at the top of the screen. It's just a fixed rate that they give you. It pays the coupons over the life of the bond, and then at the maturity you get your principal back. Floating rate notes a little different. Like the name of it, it's based on a floating rate. So the coupon rate of the floating rate note includes two components. The market reference rate. This used to be LIBOR. It still is in a lot of questions, but now it's referred to market reference rate, plus a spread. The spread is really determined on the issuer themselves, and how risky it is from, a standard government treasury bond. So the higher the issuer's credit quality, the lower the spread. Inverse relationship there. Zero coupon bond is the only type of bond that does not pay interest. These are issued at a discount price from the start, and then they're just redeemed at par. So today you could buy a bond for $850, and then in 5 years, when you redeem it, they'll give you $1,000. So the implied interest is $150. But you don't receive any yearly coupons. All right, keep moving. So several yield measures are used to determine what you're going to be getting out of this investment if you do. Most common is yield to maturity. So yield to maturity, it's an internal rate of return on a bond's expected cash flows. That is the discount rate that equals the present value of all the bond's expected cash flows until maturity with the bond's price. This, if you can't tell, is out of the book. I just think it gives a better definition than I could. But this is kind of the important part, what I highlighted. It reflects the annual return earned by an investor who purchases the bond today and holds it until maturity, provided that they receive all the promised cash flows and are able to reinvest all coupons at the same yield. So kind of one of the biggest assumptions there is that you'll be able to reinvest all the coupons at the same rate. At the same rate is what the bond is, what the yield on the bond itself is. But if you can reinvest it, then it's accurate. Another yield measure is just current yield. This is kind of just a quick one. This is just the annual coupon that you're getting right now divided by the price of the bond right now. It's pretty comparable to a dividend yield for shares. Those two kind of go hand in hand. All right, on to the bond indenture. So all that a bond indenture refers to is the legal contract between the issuer and bondholder, making it exist, more than just, saying you're going to pay this and that and all that. So there's a legal contract that's describing the form of the bond, the obligation of the issuers, and the rights of the bondholders. So like I said, in the indenture, you'll have the par value, coupon rate, maturity date, et cetera, et cetera. Collateral is a specific assets or financial guarantees securing the debt, above and beyond what the issuer promises to pay. So that gives peace of mind to the bondholders. Credit enhancements are provisions used to reduce the credit risk of the bond issue. Covenants are clauses that specify the rights of the bondholders and any actions that issuers is obligated to perform or prohibited from performing. So a negative covenant could be don't issue more debt, and a positive covenant could be try to make your credit better. All right. Some legal, regulatory, and tax considerations. Fixed income securities are subject to different legal and regulatory requirements across jurisdictions, depending on where they're issued and traded, as well as who holds them. So the interest that you receive from bonds are taxed at an ordinary income tax rate. They're not capital gains taxed or anything like that, just ordinary income. Some bonds like municipal bonds, muni bonds, are exempt from federal tax and from the income tax of the state in which the bond was issued. So there's some math you can do there to see if muni bonds would give you higher returns if you take out the taxes. I remember doing that. All right, a little more on principal repayment structures. So all this basically comes down to is credit risk. So how the amount borrowed is repaid is an important consideration for investors as it affects credit risk. So if you, the investor, are waiting longer to get your principal repaid, you want to make sure that the credit of the issuer is higher, or you have to realize you're taking a higher risk. So any provision that periodically retires some of the principal amount outstanding is a way to reduce credit risk. So we'll get into how you can do that in the next slide. But kind of the standard way of bond repayment is, like I said earlier, the payment structure of a conventional bond is known as a bullet bond, because the entire payment of the principal, occurs at maturity. So this is, conventional bond, plain vanilla. Each period you get your coupon, and then the last period you get your coupon plus your principal, and that's how you get your payment of your coupons and principal. So what ways can investors reduce their credit risk? The answer is amortizing, an amortizing schedule, whether it's partial or fully. So an amortizing bond has a payment schedule that calls for periodic payments of interest and the repayment of principal. So like in this last slide, you were getting that $35 coupon. With amortizing bond, you'd part of that would be coming from the principal. All right, so a fully amortized bond is a characteristic of a fixed periodic payment schedule that reduces the bond's outstanding principal to the amount of 0 by the maturity date. So in the little graph here, you can see in the first top half of it, you can see their cash flows they give 1,000. That's that's the principal, and then they receive a coupon each year, which looks like to be $237.40. So the first year, the interest would be $60, and then it also repays some of the principal. And you can see as the year goes on, as each period goes on, in this case it's years, the interest payment is slowly decreasing and the principal is slowly increasing. It keeps the cash flow the same each year, but it slowly gets, as it gets closer to maturity, it's repaying more of the principal. So in the final year, it's already repaid the interest and the principal. A partially amortized bond, you can probably figure that out. It's just when you get to the end of the year and the end of the last period, there's still some principal you have to pay off. It's called a balloon payment. So you can look at the second example. We're still paying the interest, we're still paying part of the principal, but when we get to the last year, the coupon plus the principal is another 200-ish. That's just because they didn't repay the principal even enough over the previous periods. Sorry. And when they get to the last year, they have to repay a bit extra principal, just to knock it out. All right, now we get to some interesting stuff. Callable and puttable bonds. So if you remember when we were talking about the bond indenture, contingency provision is a clause in a legal document, the indenture, that allows for some actions if the event or circumstance does occur. For bonds, in the term of embedded options, this refers to various contingencies, provisions found in the indenture. I just said that. Some common types of bonds with embedded options include callable, puttable, and convertible bonds. So callable bonds, it gives the issuer the right to redeem all or part of the bond before the maturity date. So say you're the issuer, right? And you issue bonds. You can issue callable bonds instead of normal bonds, and that gives you the right to I lost my train of thought. So if you issue callable bond, and you're the issuer, you're doing this because if, let's say, interest rates decline, you're like, well, shit, like now I'm paying a crap ton of money and the interest rates are a lot lower. So we're calling these bonds back. We're gonna issue new ones at a lower rate, pay a lot less interest. Boom. So it's a good way for investors to protect themselves against declining interest rates. Or let's say their credit quality is shit when they issue these bonds, and over the life of the bond they fix their stuff, credit gets better. Well, let's call it back, reissue it, lower spread. We can issue a bond with lower spread, and pay less money. Puttable bonds kind of flips it. It gives the bondholder, the investor, the right to sell back the bond at a predetermined price before the maturity. So opposite times, say interest rates are rising and you're stuck with a 2% yield, and interest rates are soaring up to 5 like they've been, you can be like, well, take your shit bond back, I'm gonna go I'm gonna go get something that pays a little bit more. Finally, convertible bonds. Um, convertible bonds are pretty cool. It's a hybrid security that starts off acting like debt and gives you the option to kind of flip it to an equity feature. So it gives you, the investor, the right to exchange the bond for a specific number of common shares issued in the company. For the investor, for us, this can be seen as an advantage because say you're holding onto a bond and all of a sudden the company's doing well, its stock price starting to trend up. You see something in the news, shoots up, and you're like, well, I don't want to be stuck with some dingy little interest payment, so let's convert the bond to shares and get some capital gains. Great. For the issuer, they kind of get, let me go back to the investor. So let's say that doesn't happen. Let's say the company is shit in the bed. Nothing's crazy happening. You just keep your bond and you get the interest payments. So you know, it minimizes the downside. You just keep the bond. If nothing happens or it gets worse, if it gets better, trade it over. Obviously that's gonna hurt your yield a bit, but when you're originally investing, but a good option for the issuer. They receive kind of two main advantages. You're thinking, you're like, why would the issuer do this? Like, they're not doing it out of the love of their heart. So like I said, the provision is valuable for the bond, for the issuer, because they can offer below coupon rates. So they're like, listen, like, you're gonna get less yield because we are giving you this option. So they're like, fine, awesome. Secondly, if investors try to convert it, and they do, your debt's gone. So you know, if your debt just disappears because more investors switched to equity, you know, you're not too mad about that. So just finally, some key terms when doing these convertible bonds. There's a bit of math involved. The conversion price, it's the price per share at which the convertible bond can be converted into. The conversion ratio is the number of shares that each bond can be converted into. The conversion value is the current share price multiplied by the conversion ratio. And the conversion premium is the difference between the convertible bond's price and its conversion value. All right, that is chapters 1 and 2. I will hand the reins over to Mr. DeForest and Mr. Shanahan.
All right, this is modules 3, 4, and 5, issuance, trading, and funding. All right, brief introduction. Global fixed income markets represent the largest subset of financial markets in the terms of number of issuance and market capitalization. It's more than 3 times the size of the global equity markets. And then fixed income markets include not only publicly traded securities such as commercial paper, notes, and bonds, but also non-publicly traded such as loans. And then going to the classifications of these fixed income markets. First, we're going to go into the type of issuer. This differs based on the 4 bond market sectors: household, non-financial corporates, government, and financial institutions. And then going to the credit quality, bond markets can be classified based on the issuer's creditworthiness, ability to make payments on time, of interest or principal, and then rating scales on Standard & Poor's and Fitch ratings are used to classify the credit qualities such as like AAA bonds. And then going to maturity, fixed income securities can be classified by maturities. Longer term securities are attractive to those who need to buy long duration assets like insurance companies. And then going into more classifications, we're going to start talking about currency denomination. Currency denomination of a bond's cash flows influence yield that must be offered to investors to compensate for the potential impact of currency movements on the bond investment returns. This could be exchange rates, interest rates, and credit worthiness. And then we're gonna go into the type of coupon next. Fixed rate notes. These are coupon payments. They fix with changing interest rates. And then next, floating rate notes, or FRN or floater, as you can see in the bottom right corner. These are attractive to bondholders when interest rates rise, and it will increase the coupon rates. Reference rates. Coupon rate for a floater is a reference rate plus a spread or margin. The new US reference rate, which took over the library, is the secured overnight financing rate, or the SOFR. And going into more classifications, first geography, distinguishing between domestic, foreign, and Eurobond markets. Domestic and foreign bonds are subject to legal, regulatory, and tax requirements that apply in a particular country. The Eurobond markets has fewer reporting requirements and regulatory and tax constraints. Favorable bonds for buying these international. And then next, distinguishing between well-established capital markets between countries. Emerging markets tend to have higher yields due to higher risk. They're newer, so that means that they are more risky to buy. And then finally, other classifications, tax-exempt bonds, inflation-linked bonds, issued by governments with low yield but extremely low risk due to high credit ratings. As I was saying earlier, the Standard & Poor's or the Fitch rankings, and many other exemptions. Classification of fixed income markets. Again, we're going into the indices. First, multi-purpose tool used by investors and investment managers to describe a given bond market or sector. These are conducted as portfolios of securities of a given bond market or sector. These can include Barclays Global Aggregate Bond Index, or JP Morgan Emerging Bond Index Global, or even FTSE Global Bond Market Index Series. And then going into the investors that are in these fixed income bond securities. First, central banks, open market operations that purchase or sell bonds, usually but not exclusively sovereign bonds issued by the national government. Then next, these are the institutional investors, pension funds, hedge funds, charitable foundations, insurance companies, and more. This is the largest group of investors of the bond market. And then next, continuing on institutional investors, is the over-the-counter markets. These are more difficult to access than the equity securities. Institutional investors tend to invest differently into these bonds. And then finally, retail investors. These retail investors find fixed income securities attractive due to the relative stable prices and steady income production. And then now we're going to be talking about the bond market. Just a brief introduction here. The primary bond market are markets in which issuers initially sell bonds to investors to source or introduce more capital. Primary bond markets are marketing in which existing bonds are subsequently traded among investors. Public offerings, these are underwritten offerings. Investment banks guarantee the sale of bond issue at an offering price negotiated with the issuer. Some examples for these could be syndicated offering. A lead underwriter invites other investment banks to syndicate and coordinate the effort. Or a gray market, forward market for the bonds to be issued, determine what the price offering should be. And then best efforts offering. This is when investment banks serve only as a broker, since he's a douche and who cares more about commission than other people. And then shelf registration allows certain authorized users to offer additional bonds to general public without having to prepare a new separate offering for each issue. And then auctions, a method of involving bidding and helpful and providing price discovery through facilitating supply and demand. Example of this could be primary dealers. These are financial institutions that are authorized to deal in new issues of U.S. Treasury secretaries. And then continuing on the primary bond market, we're going to be talking about private placement. This is typically a non-written, unregistered offering of bonds that are sold only to an investor or a small group of investors. This is large institutional investors. They release in small aggregate amounts by unknown issuers at the time, and then unlike a public offering, investors can influence the structure of the bond issue. And then an example of that is asset or collateral backing, credit enhancements, or covenants. And then finally, syndicate loans. These loans from a group of lenders to a single borrower. And then going to the secondary bond market, just a brief introduction again. This secondary bond market doesn't have a usual electronic marketplace to buy and sell these bonds. They're usually quote driven or over the counter. Most owners are institutional investors, financial intermediaries, and then central banks. The market for this is the secondary bond market. Varies widely across the segment, as well as bonds outstanding from a single issuer. The bid offer spread out what the dealer would buy or bid from what a customer and sell or offer to a customer is a key liquidity measure. The spread is measured in basis points. Sovereign bonds are the most liquid bond security, and then underwriters and other dealers are more likely to hold trading inventory in recent issues and quote bid offer spreads a few basis points. Bonds of less frequent corporate issuers have large spreads, at least 10 to 20 basis points to the tight basis points of the dealers. And then finally, distressed debt. Bond issuers believed to have very close to or in bankruptcy. Some of these examples could be priced below par because bondholders are unlikely to receive all promised future interest and principal payments. Investors with policies that limit their bond investments to highly ranked securities may be forced to sell distressed debt. Distressed debt is traded until the corporate issuer has liquidated its assets or outstanding bonds have been restructured. And then in contrast, an equity security may be removed or delisted if it fails to meet the listing requirements of the exchange. This could include minimum share prices, net worth, or even free float. And then going into sovereign bonds, again, we're just going to go into a brief introduction, then go into characteristics and quality. First, a debt that is issued by government that its purpose is for financial spending programs. This could be, for example, infrastructure programs, social programs, war efforts, or other programs they need to spend for. Characteristics: on the run securities, most recently used sovereign securities. And then benchmark issue, this is used to compare to other bonds that have the same features. And then as sovereign securities age, they trade less frequency. This is a basic general rule that's gone with these bonds. And then credit quality of these sovereign bonds. Common to observe a high credit rating for sovereign bonds issued on local currency than those issued for a foreign currency. And then national government has the ability to increase or decrease taxes and then print money. And then we're going to go into the types of these bonds. First, fixed rate bonds that pay a fixed rate of interest. These are the most common type of bond. Floating rate bonds, bond prices that change in the opposite direction from the change in interest rates. And then inflation-linked bonds, cash flows that are adjusted for inflation. Another type of floating rate bonds, and these inflation adjustments can be made via coupon payments, principal, or even both. And then non-sovereign, quasi-government, and supranational bonds, non-sovereign bonds. These are typically issued in financial public projects such as schools, motorways, or other infrastructure projects. Interest and principal payments are sourced from cash flows from the project as well as the taxing authority. Non-sovereign bonds usually trade at a higher yield and lower price than sovereign bond with similar features. And then the quasi-government bonds or agency bonds. These include issued by organizations that have public and private sectors characteristics, but are also not government entities. This could be the Freddie Mac or the Fannie Mae quasi-government bonds that do not guarantee a full payment, but offer investments. Well, investors do perceive this. And then high credit rating due to low default risk, but it can sometimes be backed by collateral. And then finally, supernatural bonds. Bonds are issued by supernatural agencies. These are also called multilateral agencies. Examples of this would be the International Bank for Reconstruction and Development, the World Bank, and then the International Money Fund, IMF. Typically, vanilla bonds, although floating rates and callable rates are sometimes issued. Highly rated supernatural agencies frequently issue large-sized bonds that can be used as benchmarks when there's no liquid sovereign bond available.
All right, so I'll now get into corporate debt, bank loans, syndicated loans, and commercial paper. So bank loans and syndicated loans. I'll start off with bilateral loan, a loan that from a single lender to a single borrower, the primary source of debt financing for small and medium-sized companies. And then for a syndicated loan, a loan from a group of lenders called a syndicate, a hybrid between relational lending and publicly traded debt, is a way for institutional investors to participate in corporate lending while diversifying the credit risk among the group of lenders. There's no structured secondary market for syndicated loans, even though there can be another market for it. There's no structured secondary market. Most loans of this type are floating rate and are more expensive than bonds issued on financial markets when issued by a highly rated company. Now into commercial paper, short-term unsecured promissory note issued to the public or private placement. First issued in the United States, but later in the UK and to the rest of the world. So some characteristics of core commercial paper, source of readily available and low cost short-term financing. It's often used as bridge financing, which is interim financing that provides funds until permanent finances can be arranged. For the credit quality of commercial paper, only the largest and most stable companies usually issue corporate paper, but the credit risk comes from smaller companies issuing higher yield commercial paper. This is very rare to happen, but security to this is a backup line of credit from banks to ensure that the issuer will have liquidity to repay the maturing paper. Defaults on commercial paper are relatively rare due to the short maturity that they have. U.S. commercial paper versus Euro commercial paper. U.S. commercial paper is the largest commercial paper market in the world. The differences occur related to interest provision, which is on the lines of how the U.S. issues on a discount basis, where your commercial paper can be traded on a discount basis or an interest-bearing yield basis as well. Now we're going to get into corporate debt in notes and bonds. So for maturities, no universally accepted taxonomy for what constitutes short or long-term or medium-term maturities, but for our purposes, 5 years or less is short-term, 5 to 12 years is about intermediate term, longer than 12 years is long-term. Securities with maturities between 1 and 12 years are often considered notes, while securities with maturities greater than 12 years are often considered bonds. Longest maturity is usually a 100-year bond or century bond. Disney has issued these in the past. Medium-term note is the note that makes no sense because it can have a very long maturity, but the initial purpose was to fill the funding gap between commercial paper and long-term bonds, or the medium term. So for coupon payment structures, to briefly go into the overview of some of these structures, floaters or floating rate bonds are coupon rates adjust to changes in interest rates, and if they're inflation linked, coupon rates adjust to the changes in level of the consumer price index. For credit linked, coupon rates adjust to change in issuer's credit quality. Zero coupon, no coupons for you. Deferred coupons, you will not have coupons at first, but then they're offered at a higher coupon after about 3 years, depending on the issuer. Payment in kind is our periodic coupon payments, but not always in cash. It could be in common shares or other securities, or maybe even a birthday cake. Principal payment structures, two main types of repayment structures. There's serial maturity structure, which is maturity dates are spread out during the bond's life. And term maturity structure is bonds notional principal is paid off in lump sum at maturity. It can be similar to a serial maturity with a sinking fund arrangement, which makes the issuer set said funds over time to retire the bond issue, and this usually happens randomly on an annual basis. So for asset or collateral backing on bonds is a way to secure corporate debt using different ways in which lenders are repaid in the event of an issuer defaults. During a company bankruptcy, proceeds investors of secured debt fare better than unsecured debt investors because secured debt is with asset or collateral backing, and unsecured debt, you don't have anything backing your assets or your bonds. So you're basically screwed. So contingency provisions, they're clauses within a bond indenture that provide the issuer or bondholders the effect of disposal or redemption of that bond. And these are usually called put or conversion provisions being convertible bonds into stocks. Issuance, trading, and settlement processes of settling and issuing bonds are now essentially the same with electronic settlement. Bond prices are usually quoted at basis points, and the vast majority of corporate bonds are traded on over-the-counter markets where dealers sell bonds from their inventory, but there are bonds that are, or corporate bonds that are traded in the New York Stock Exchange as well. Now into structured financial instruments. And structured financial instruments are representative of a broad sector of financial instruments, include collateralized debt obligation as asset-backed securities, usually combines a bond and at least one derivative, which gives the insurer exposed to one or more underlying assets. Capital protected instruments are typically issued with a zero coupon bond issued at a discount always, where an investor purchases a call or put option on an underlying asset that can be sold at a predetermined price. And the guarantee certificate of this is a package deal of a zero. This example of this, a credit linked note, allows the issuer to transfer the effect of credit onto investors. This is a floater. There allows the investor to participate in the return of the underlying asset. In the essence of a floater, investors participate in the movement of interest rates and usually do not offer capital protection. Leverage instruments created to magnify returns in the apology that high payouts from small investments. And then you see here the inverse floater, cash flows are adjusted periodically and move in the opposite direction of changes in interest rate, as you can see here from the picture on the right, with basketball players doing a floater up and down. Inverse floater coupon rate equation is the coupon rate minus the leverage times the new rate. So inverse floaters with a coupon greater than 0 but lower than 1 are deleveraged inverse floaters, and inverse floaters with coupon leverage greater than 1 are leveraged inverse floaters. All right, so last topic, short-term banking funding alternatives. Just a quick introduction, amount of money or resources to finance some specific product or enterprise. So the first most basic one is retail deposits. The primary source of funding are deposit taking banks, demand deposits or checking accounts. Depositors have immediate access to those funds with no interest paid. And then you have savings accounts where they have immediate access to those funds, but they do have a market rate of return or interest rate. Short-term wholesale funds, reserve funds, balance placed within the national central bank to serve as a buffer to liquidity if depositors require withdrawal of funds. The central bank funds market allows banks to have a surplus of funds to lend money to banks that need funds, called overnight funds, which is usually a 1 day to maturity, or term funds, which is up to 1 year. Interest rate used for borrowing in the US is the Fed funds rate. That's different in other countries. Interbank funds. Interbank market of loans and deposits between banks. It's a rate of an interbank loan or deposit can be quotes based on a reference rate, such as an interbank offered rate, which is something like the LIBOR or the SOFR. Interbank deposit is unsecured. Interbank line of credit is necessary. There's a two-way price. For larger banks, the rate will be indicated for lending funds, and the rate will be at which it will borrow the funds. So large denomination negotiable certificates of deposit. So a CD is an instrument that represents a specific amount of fund or on deposit or specified maturity and interest rate. A CD can take one of two forms, which is non-negotiable, negotiable, when non-negotiable being the deposit plus the interest is paid to the initial depositor at maturity, and negotiable allows the depositor, initial or subsequent, to sell the CD in an open market prior to maturity. And there are two types of those negotiable CDs. One is large denomination. In the US are offered at $1 million or more, and are important sources of wholesale funds, typically traded among institutional investors. And there's small denomination, which is a retail-oriented product of secondary importance as a funding alternative. CD maturities are usually under 1 year, but can be longer, in which they are called term CDs. All right, now, actually, this is the last topic. Repurchase and reverse repurchase agreements. So a repurchase agreements, or repo, is the sale of a security with a simultaneous agreement by the seller to buy the same security back from the purchaser at an agreed on price and future date. Structure of repurchase and reverse repurchase agreements. The repurchase price is the price at which the dealer repurchases the security, and the repurchase date, or repo date, is the date when the security is repurchased. When the agreement is for more than 1 day, it is a term repo. Repo rate is the interest rate on a repurchase agreement, and factors that influence the repo rate is the risk associated with collateral, with lower rates for higher rated collaterals. Terms of purchase, rates generally increase with maturity. Delivery requirement of collateral, lower rates when delivery to the lender is required. Supply of demand and collateral. Interest rates or alternative financing in the money market. Coupon rates belong to the seller or borrower in repurchase agreements. That's one thing to note. And then a reverse repo is when the repo is viewed through the lens of the cash lending counterparty. The credit risk associated with purchase agreements, repo agreements, the lender of funds is the most vulnerable party, especially when the amount of lent is lower than the collateral market value. The repo margin, or the haircut, is the difference between the market value of the security used as a collateral and the value of the loan. The level of margin is a function of the following factors: length of repo agreement. Longer agreement equals a higher repo margin. Quality of collateral, the higher quality, lower the repo margin. Credit quality, higher the creditworthiness of the counterparty, the lower the repo margin. Supply and demand conditions, repo margins are lower if the collateral is in short supply or the demand is high for it. Thank you for your attention. I hope that's correctly in French.